It's good to see everybody in 2014 again. It's fun to be up here speaking again as well. I'm a little afraid because I can't see the screen or my notes, but that's all right. We'll be fine. I wanted to come out to talk tonight. We were asking about topics that seemed of interest to everybody, and so I was coming out to talk tonight about distribution to raise for VC funding. My disclaimers first, right, is that you'll never get legal or tax advice from me. I will approach this from a distribution focus. There's 100 other things that you have to do to successfully get VC funding. I'm not really going to talk about them all that much tonight. You notice I use the word distribution a lot. It's because I find the word marketing a little bit too narrow, and I find the word product a little bit too narrow. I sort of smash them all together with a dose of design as well, and I just call it distribution. And so you will hear me sort of more broad than pure marketing tonight, and more broad than pure product or design as well. But I still, it's a pretty narrow focus with respect to everything you need to get funding. It's still too broad a topic. There are some bullets in my presentation tonight that I could do a whole talk on, and it would put you to sleep, but I would be excited about it. The other thing is I'm going to talk about general sort of things that apply to a lot of people. Every startup's a snowflake, unique and individual in our own special ways. It really is true. So think about why I'm saying what I'm saying, and think about the point that's underneath here and how that applies to your snowflake more than thinking about applying exactly what I'm talking about. And the other thing is, I'm going to speak a lot from the lens of disruptive software. I can talk about where I came from, and that's most of what I come from, is the disruptive software space. More about where I came from, I guess. I'll be speaking. You always learn more from the mistakes, right? So to tell you a little bit about my scars, I've been at 4 tech startups myself. The 4 tech startups have raised over $500 million. I never totaled that until tonight. It's kind of a big number to me. But yeah, I know. Well, so in fairness, I did not raise that money. I was product, marketing, design, leadership at the companies raising that money, which is why I'm talking about product, marketing, design, distribution to raise, not raise. And then I've been involved in dozens of advisory roles that got funded, mostly friends, companies that I used to help on the nights and weekends. Had a lot of fun doing that. And then more recently, I'm getting to see things from the other side. It's because a friend of mine and I are in a new venture capital fund, Subtraction Capital. A small, new fund, first fund, about 6 months old. So I'm getting a new perspective from the other side, but I still remember pitching a lot. So start with the seeds, right? The earliest stage of funding. And I did a whole slide on just the problem, because it really is that important. Unfortunately, we don't say how will your technology make the world a better place. It's just, there's a big difference between that and how can your technology make the world suck less, right? And, oh wow, sorry, I did this in Keynote and it lost the strike through on the word vitamin. Nobody funds vitamins, right? Everybody funds pain pills. The ease of pain releases dopamine in the brain, right? And that's what people like. That's what they want to do. That's what they can't stop doing. Vitamin, you're not sure if it really worked or not. You have to take it a long time. There's really no feedback on it. Maybe you feel kind of good about yourself for doing it, but as soon as you take the pain pill, man, you get the dopamine. You feel good, right? And it's why, I use the word addiction and addictive design when I'm talking about a lot of things, design and apps. Some people don't like it. They think it has a negative connotation, and so they say habit forming. I'm not really picky on it, but the goal here is to make an app or to make a company not that people will love and feel warm and fuzzy about, that people would die if they didn't have around them, right? And that's what people want to invest in. So forming your problem correctly is big time. One of the most famous venture capital firms in the Valley is in part famous because your problem fixed must assuage one of the 7 deadly sins for people. So you have to help people with some sloth or gluttony, or you're not getting funded by them. And then the other thing, at seed stage funding time, venture capitalists are going to want to validate your problem. And so if you have an enterprise company, they'll often go out to their other portfolio companies, and they'll ask them, is this problem real? Do you feel it? Would you pay to relieve it? What about the relief of it would you pay to do, and why? Similarly, if you have a consumer product, venture capitalists will call their friends, their moms, their aunts, their uncles, and people in whatever consumer spaces that they think are applicable, and ask the same types of questions about those. And so they're going to validate your problem, and they're going to spend a lot of time validating your problem. And so a lot of focus on the problem, and building the problem and crafting the problem is part of crafting the market that you're going to go after. So I count it as a big piece of distribution. There's some other pieces. I put run rate down, and it's sort of true, right? Conceptually, some rough numbers, rules of thumb, and as soon as I say it, a whole bunch of venture capitalists will say, we don't have that limit, we don't have that rule limit. But as some rough guides, everybody sort of wants an IPO that's at least $1 billion market cap. Everybody thinks that disruptive software anywhere multiples are something like 10 times top line run rate, assuming margins and mechanics of the business look like disruptive software business mechanics, right? So everybody wants like 100 million run rate for the top line as a potential for the market that you're going after. Now, some firms have gigantic funds, and 100 million run rate doesn't even wake them up. And so I know for a fact some people have 500 million run rate cutoffs. And then some truly don't look at a cutoff per se. But if you're below 100 million run rate top line, unless you're really valuable and really, really, really sort of unassailable, you're going to have a hard time. So you need to be aiming for at least that big a market if you're going after the venture capital approach as the broad rule. Remember the snowflakes. But people aside, so my experience has been folks are looking for 3 qualities in the founding team, typically 2 co-founders, because one co-founder can't cover all 3 of these off at an expert level. The tech, distribution, and product, right? Distribution is the one I see a lot of people sort of chip on lately. I see a lot of solid co-founding teams that have tech and product. But those are sort of the 3 general ones. There's also something to be said for, is this the first time at the rodeo? Or have you been through this before, right? And I'll get back to that a little bit later down. The multiple involved, so I talk mostly about disruptive software, and a 10 times top line run rate multiple is a very rough rule of thumb. Other business models will have different multiples, and mostly people are still going to be looking for that $1 billion market cap kind of space. So, but the multiple talk to perceived value. Bonus points for virality, and the golden snitch is there if you're a Harry Potter fan.
What's the flower pot about?
What's that?
What's the flower pot?
Just the rest. There was a seed on the slide before. The question was, what's the flower pot for? So that's the dirt and the fertilizer and the water and the other stuff. But the seed's really the problem. So yeah, if you can get a viral coefficient greater than 1 with a short time horizon when you're still looking for seed stage money, more power to you. It doesn't happen very often. It is the golden snitch, so if you find it around you should grab it and win. Right? Yeah, right on, man. But there's something to be said for looking for even viral coefficients of 0.2, 0.3 in the early days. Because if you can show some virality at all, it's still going to help you, and you'll still get bonus points for it, right? And to some degree, what you focus your intention on, you're going to find, and you're going to get there. So you should focus some intention on the virality you can get in front of you. Network models, especially the kinds of networks where winner takes all or most, will get you some bonus points for sure, and there's plenty of them out there still. IP, you don't see much in software world. It's out there, but honestly, you don't see it a ton in software world, so I'm not going to spend a lot of time. And now the bar, right? Venture capital and venture capital funding is supply and demand. There is so much money committed that's out there that people want to invest, and there are a lot of companies asking for it. So they have this bar, and the bar slides around, right? Back in the late 90s, when I was getting started, you really didn't have to have much software there yet. You had to have a team that was credible and sound like you knew how you were going to build some software. But today, so much overhead has been taken care of for us, right? Remember, in the late 90s, the first thing you were going to do is buy a cage and fill it up with rats. Yeah. And so today, you're gonna get onto Amazon, and you're going to cloud-base all of your infrastructure. You're going to use jQuery, so your front end has already got a lot of bells and whistles. Well, even jQuery, I'm told, is out of date now. But at any rate, you have a lot of tools and a lot of infrastructure that's already there. So there's an expectation that you're further along. And I was talking about the people before. If you've got people that have been to the rodeo before, you might not have to be quite as far along. They have some confidence that you can get from idea to wherever. If it's your first time, you're just getting out and you've got a dream and a great idea, you're going to want to see a little bit more traction along the pilot of whatever your product is before there's going to be confidence to invest in a seed. And then this sort of progress on this pilot, to me, ends up being more the seed stage bar. It's variable based on the people, like I said. But to some degree, the venture capitalists can sit back and go, well, everybody's getting a lot further than they used to be. That's cool. We'll invest in the ideas that we love that meet all the other criteria that I just talked about that are furthest along. And so it becomes a sort of sliding relative bar, you relative to everybody else that you're sort of at the same everything else with. Does that make sense? So I mentioned the bar here. I'm going to mention the bar again in the A round because it's a different bar. And that's my quick version on Series C. Series A. First focus is the big one always, right? It was the problem on seed. Now it's product market fit. And everybody wants to see product market fit nailed. Defining product market fit and showing product market fit is different depending on what your market is. If you have enterprise customers, I hear some people say 5 or 6 solid, meaty-sized customers that are willing to say that they couldn't live without your product is enough to get to Series A funding and to show that validation. If you're a consumer, you might just have a bunch of fanboys in the beginning that were excited to adopt your product. But regardless of what it is, you need to show some core audience and some core piece of your market that's dying to use it. One of the famous questions is to go out to your customers, whether it's those 5 people or whether it's a whole bunch of your random consumer customers, and say, how would you feel if I took this product away? And then, you want to see despair in their eyes, and panic, maybe some little preterm grief, right? But that's the goal. And then when you're looking for Series A funding, you probably don't have a really good, solid feel on what LTV is yet. So start to look for LTV proxies, lifetime value proxies, sorry. So, what does conversion look like? What does engagement look like? What does retention look like? If attrition is really low, then there's a chance the lifetime value will be good, right? If people are really excited about the product and they're willing to pay a lot, even though you've only got half the functionality there right now, there's a good chance that when you get the rest of the functionality built later and get them ramped up and provide the full value, that you're going to have a solid LTV. So they'll be looking for proxies like that. It gets more fun, right? Here's the first cohort curve I'm going to put up. It won't be the last. I'm a big fan of cohort curves for those who know me. But so here's a basic graph of active users, right? I'm going to walk through it. On the y-axis here, it's active percentage. And I'm saying this is months since you signed up. So by definition, in the month that you sign up, at month 0, 100% of your sign-ups are active. So if you take all the people that signed up in January, say of last year, so 12 months ago, you track them month by month. This is my long line right here. And each month, fewer and fewer of them are active. And at some point, you plateau and you fall out to some level. And there's actually a lot of early active cohorts that look a lot like what I drew. And then this shorter curve means we don't have as much data. Maybe we had 9 months worth of data. So maybe these are the people that signed on in Q2 last year or April last year, however you want to look at it. Everybody starts at 100%. Maybe your product was getting better. Maybe your marketing targeting was getting better. Not sure. But regardless, your active rates are a little bit higher. So hopefully every subsequent cohort is going up. Well, these cohorts are a first place to start to look for product market fit. A lot of people going out saying, we're building this product for this market. They put the product out there in the marketplace. The most common version of this, by the way, is this will work for everybody horizontally across this whole industry. You hear that all the time in seed stage kind of stuff, right? And then they go out to the marketplace, and you get this cohort curve, right? You're like, wow, 90% of our people aren't remaining active. They're bailing, right? Well, you can segment cohort curves, right? So I put a green one up in this example. Let's say this is one of the verticals that your product works really well for, actually. So the active percentage on this piece of the cohort is much higher than your average. And let's say this is all the rest of them, right? And they're just fizzling out to zero. Well, if you're segmenting based on cohort and looking at things like this, you can see which part of the market your product is appealing to. And by definition, you have some product market fit there. And you have a couple choices on how you want to go with this, right? You can just go, you know what, they love the product, they're a great market, maybe we should just own that piece of the market. Really just double down and point right there at it. Or you could say, wow, we're missing a few things that could attract this piece of the market, and we think that if we add them, maybe we can get both or all. They both can be valid approaches. You have to worry about dilution and focus and all that fun stuff if you decide to try to roll both pieces in, but that's sort of a basic way to start looking at what is your product market fit de facto. If you have some people that are sticky and using it and like your product, but it's not necessarily everybody like you expected it to be. The other comment I want to make while I have my cohort curve up is you can build cohort curves on lots of stuff, right? The other thing that you could do is you could look at mechanics. And this is some of the famous cases that you should look at, actually. If instead of an attribute of the customer, like which vertical they were in, these lines were people that signed 7 friends up in their first week and people that didn't, right? And that's a famous metric. There's several famous metrics from the likes of Facebook and Twitter like that you can look at. They're very discriminating things. So then the question becomes, there's a little bit of a chicken and egg follow-on question to that if you find such a discriminating variable like that. Then the question becomes, if we make it really easy, or we shove it in their faces, or we even pay these people, right, to do whatever it was that these people did, will they still stay on at this high rate like this? Did doing the action make them loyal? Or did they do the action because they were inherently loyal in the market? And either might be right, but there's only one way to find out. And that's to go out there and test it in the marketplace. And so those are 2 things to be doing with cohort curves with respect to product market fit early on that are really, really important. And if you can understand these, like the cohort curves are the mechanics of your business. They are how your numbers really operate, and they're how your models really roll up. And if you're using averages to look at how your models roll up instead of cohort curves, I promise when you're in your Series A due diligence, the venture capital firm that's looking at you will go in and re-cohort everything. You don't want that to be the first time you know your cohort numbers. You want to know what that story is before they look, and you want to make sure it's a good story. Yeah, and the other Series A game, you have time to play with the revenue model that you're going to use. And, you know, I listed several of them up there just because the cohort curves that you use for different models are different. So I don't have time to drill into every single one of these, and I'm not going to. But I'll say for a media company, what you want is, even if it costs you some money to get to the site, with some effort, or some valuable time, or precious resources at your small startup, if the people stay, and they keep coming back over and over again, and if they invite other friends, and they're viral, they can be worth a lot over a period of time in the media game, right? Because you're going for impressions and long-term, maybe even lifetime engagement. Whereas, if you're going for a freemium model, you're going to be looking a little bit at just getting people to sign up for the free product in the beginning. Maybe a little bit of focus on how many can we convert to the paid later, but honestly, that can come later. If you can get people excited about the free product, you can say, hey, there's something here. Like, we're doing something for people. They wouldn't bother to sign up, and they wouldn't keep using our product and stay engaged with it. And so, for every different kind of model you can chase, there are going to be slightly different metrics. So find the right ones for you, find the right cohorts. You can cohort virtually anything. You can cohort 30-day active. The bonus points for Series A, right? So now is the time to start building your funnel. You don't have to have these statistically significant jillion people through the funnel numbers that's totally optimized yet. But if you can show you understand what it's going to look like, you understand how you're going to go about optimizing it, you're going to go about attacking the funnel and improving it, bonus points there. Cohorts, big bonus points, like I said. I think it just shows that you understand your business better than a lot of people. Bonus points for addictive design. If you get a design that people start to use and they never stop and they don't break down, that's great, right? And actually, you should watch Near's talk, Hooked, if you want to learn addictive design. That bullet is an entire talk, and he gives it better than...
Who gives it?
Near Eyal. E-Y-A-L. Sorry, I plugged him too. Seeding the funnel, so you can learn interesting things seeding the funnel, so-called seeding the funnel, because you're trying to learn how your product is engaging with the market early on, but you got to throw some just random people, customers into the funnel. I call it seeding the funnel. And if you're lucky, you can learn something about the channels that are going to work or not work for you later. I mean, don't get me wrong, you can do anything it takes to seed the funnel. You got to get 50 people in, go in and put 50 Craigslist ads in, right? Like whatever it takes to get your people through so that you can start to evaluate product market fit, and so you can start to talk to the customers that stuck and the ones that didn't and figure out why. But if you get really lucky, you'll find out that, wow, I could just go to AdSense and for a $2 CPA, I can get people all day long. And it looks like I can just scale that later. And if you can find those nuggets, those are good information to take into your Series A plans to say, yeah, after we get money, we're going to go bang that one because we already know it works. Back to virality, network, and IP, they're still there. It's still the golden snitch. You still might find it between seed and A. And then thinking about scalable growth, like I was just talking about, you don't have to demonstrate scalable growth yet. You have to demonstrate that you know how to think about it, and that if you have a bunch of money to go out and do whatever things you do, whether it's build software, whether it's blog, whether it's create viral loops, whether it's buy advertising, whatever it is, that you know how to go about looking at this, thinking about it, optimizing it, you can put that money to good use. And then the Series A bar, progress, right? And so now, that labeled the Series A crunch is just an excessive supply to me. There are a lot of startups that got seed funded. Even if the historical seed to A round success rate was 20% lower than the past, because there's a lot more funded now, there still isn't enough money in all of Silicon Valley to follow on with A rounds for those that historically would have been funded, right? And that's just a fact. And so what I'm seeing a lot are people that fund A rounds sitting back and saying, okay, that's everything else I just talked about, being equal, that's the bar. And we'll just raise the bar until few enough people clear it that we deploy our capital. And so you want to get as much progress as you can toward everything I was just talking about, scaling, getting customers in, building a business model, because you're going to be compared relative to the other startups in your cohort.
How do you distinguish between A round and C round? What's the difference?
Seed round and A round?
Yeah.
It's a label, but typically A rounds are more in the 5 million-ish kind of ballpark with 20 million-ish valuations. The other, you guys probably already know all this stuff, but 20% is sort of the ownership metric for a lot of firms. Not everybody, and some people would be mad at me for saying that, but it is sort of the magic number. A lot of firms don't want to invest their time. One partner at a firm can only help so many companies at the same time. And so you want to own a significant enough piece of those companies that if they become very valuable, your time was leveraged as much as possible. And so 20% was historically sort of the magic number. So if a firm wanted to get 20%, 5 million into a 20 million valuation is really, really rough. Seed rounds right now are in the like 3 to 5 million kind of valuation, typically maybe 1.5 million. Sometimes a little more, sometimes a little less.
Sorry, could you say the seed round numbers again?
Seed round, typically $3 to $5 million valuations. If they meet the progress in the pilot that I was talking about up there, with a 1.5 million-ish kind of race. Those are rough, but not bad. Growth rounds, I'm not going to hit this too hard because I think Mike would do a better job than me. But I always say my two bread and butters were just showing two graphs that I understood well. And one was, I'm increasing volume, and it's better to be exponential. VCs can do calculus. if business looks exponential like this, then every month you're getting more users, right? If it's linear, you're getting the same number of users every month, and we know this. And if it's plateauing, the number of new users you're getting each month is actually declining. So it better look like this if you're going to show cumulative, right? Or you can show it by month, and then it just needs to go up. But it usually looks better to show an exponential cumulative, so that's what you show. And then the cohort, whatever it is. So in my world, trying to manage and keep things simple, when I worked at Boeing and we designed airplanes, we tried to focus on quality. And we said if we built an extremely high quality product, that the manufacturing costs would be lower, so the profits would be higher. We could lower the unit costs, which meant the sales would be higher. Basically, everything would take care of itself if we designed and built an extremely high quality product. And so we could focus on that one metric. And I always wanted it for software too, right? I learned all this manufacturing stuff at Boeing, and then I came to work in software, which has ended up being pretty useful actually, from a process control and other points of view. But I always wanted one metric. I always wanted that quality metric, and I've only been able to get to 2. That's the best that I could do. But so 1 is just pure volume. How many people do we have coming in? And the second one is just the quality, if you will, of those people coming in. So if you have tons of volume, so this is always a unitized number, right? If you have tons of people coming in, but they're worth less and less per person, you might not actually be creating much value. But if both of these are going up, you're getting more and more people in the front door, and they're worth more and more all the time, then you can focus on those 2 metrics, drive them up, and everything else will take care of itself. And that's what I was always sort of looking for as my silver bullet. Now, I can drill into 100 variables, and I actually kind of enjoy doing that. But at the top level, I wanted 2 if I could to drive everything. I already talked about cohort. I think right here. Oh, sorry. Had to end there, but I'm good now. Mike, I think I got everybody sufficiently asleep. It's time for you to come wake them back up. I'm going to introduce Mike Harden and let him take over.
So it's nice to be here in official capacity. Usually I'm cleaning pizza off the floor and stacking chairs. If you've seen me before, here a lot of metrics for companies that I've been attracted to fund. So I'm kind of here to figure out how he's been doing it. Not really quite sure. In fact, we actually tried to hire Paul, but he snuck away. So I want to show you Sir Fedora for a couple of reasons. Oh, are we no flash? Oh well. We have to help this kid get some likes, basically, that's it. But, alright, I'm going to, that's really disappointing.
We'll email out the link afterwards.
Yes, that's him. Alright, I'm going to launch right in here to my presentation, which is not as slick as Paul's. This is hard without. Yeah, okay. Alright, so again, I've been trying to figure out what Paul's been doing with all these companies, and I've read this book here, How to Lie with Statistics, but it does look like it's accurate. So there are 2 parts to it, right? One's actually having the numbers, and the second part is displaying those numbers. So who is this guy? Artis Ventures. We are a small team. We've been doing ventures since about 2005, probably done about $500 million worth of venture deals. We've managed to, we've seen our share of winners, we've seen a few losers, and we've tried to associate ourselves with some brands. You can see some that Paul's been associated with there as well. So, venture capitalists, love them or hate them. You remember the famous scene from Zuckerberg there in his bathrobe going to give his original VC the FU. And we actually, this is a real picture. We actually, up in Toronto, we just were in a meeting and those guys had that out front. So they definitely got money. So, whatever it is. But, it's people like Paul, especially at that earlier stage, who really do add value. If you're working with your VC, at that early stage, then they can help you orchestrate and get those numbers to a point that's going to attract somebody for that later stage growth. So there's 3 things. One, you got to have the data. So I love this little cartoon here because a lot of times when we meet a startup founder, they don't even have any. Going back to that point, the bar is raised a little bit now. You kind of have to have something at this point in time to show. The concept plays are really for people who've done it before, and I've made money with you in the past. So you've got to have some data. The second thing is the data's got to be sort of relevant, because I do see this from time to time. Guys who come out and there's all these charts going on and it looks good, but I did not do well in calculus, but I know enough to know that this isn't really that relevant. And then the third thing is a lot of guys have good data, but they're not showing it the right way. And that sort of blows my mind sometimes. And those are some of the good finds, but look, it's the same chart. But you can see that obviously there's ways to play it. I mean, I think we've all been through school where you have a 2-page report, and when word processing first came out, I'm dating myself, but you could definitely stretch that 1 page into 2 with some creative spacing. And I definitely advise a little bit of creative spacing in your chart there. So that brings us, this is a similar picture to what Paul put up, but I want to talk about from the perspective of the type of pitch that you need to do. So I actually come from this, from the exact opposite end, which is a nice fit with Paul. He's coming at it from having worked at these startups. I'm coming at it actually from the public markets. I moved out here in the 90s in order to research and write about and help take public the early mobile data companies, the Palms and Handsprings of the world. And so I spent a lot of time on that financial pitch. Those are companies that we're not even worried about eyeballs and all the BS metrics. We're talking about real hard, cold cash. And if you have that and those revenue numbers are going, then it's great. Later on, I'll show you some slides from LinkedIn, and you can see that on the IPO, that's really all you're talking about. So this is the league of real, and there are hundreds of people who are just crunching your numbers. So this is the real financial pitch. Here in this stage, these are sort of the vanity rounds, those late stage rounds. The Dropbox did $3 billion, or somebody else came in for multi-billion rounds, Uber doing 3 or 5. Those are still data/financial pitches, but those are real numbers. These numbers are going up and to the right in a pretty big way. These two are pretty obvious. When you see them as a venture firm, you sit down and you go, okay, yeah, that's pretty clear that this company's going somewhere. It's this part right here. This is the concept pitch, which it's transitioning from that, hey, I'm a guy with an idea and some tiny numbers, to this point here where you've got a little bit of data, but you're still selling a story. That's the hard part. And Paul's absolutely right. That Series A crunch is partly supply and demand, but it's also, because there is so much supply, it's also really hard because you've got some guys who have both. You've got some guys who have a lot of data and financials already. You've got some people who have a great data story. So this is where, it's actually, I don't want to belittle it, but it's pretty easy to get a seed round in this city, in this day and age. There might not be an easier time to raise seed money, 750 grand, $1 million, not to be trite about it, but it's relatively easy. If you think that's hard, wait till you get here. Because that 750 grand is only going to buy you 12 months, 18 months, depending on how frugal you are with it. And that means from the day you take that money, the clock starts ticking for you to show that data. And if you don't have that data by the time that 12 months is out, you're working back with, you're moving back home or whatever else it is. And so again, why not both? Because some of your cohorts do have both. They have users and they have financials. So I'll let you in on the big secret though, once you get into that growth stage. The big secret is you can set your own hurdles. On the financial side, you can set your own hurdles. How many of you have seen Apple or Facebook, stock dropped 20%? Oh, they reported earnings. Well, the secret is they set that earnings goal. 3 months prior, they told you, we're going to grow 5%. And then they came out and they only grew 4%, and the stock's down. They set that hurdle themselves. In hurdling, you don't get to set your own hurdle. You have to jump what's put for you. But in the growth stage, you can actually, it's your job to tell me what metrics are important. If you've gotten to that B round, or if you're in that point, you already have some sense of where you need to be and some sense of what metrics are important. So I'll come in and argue with you, but you have an opportunity to center around the concepts. That's where your concept piece, no longer is it a BS, just a story with no metrics, but you need to create a story with the metrics that you have. And if you can sell a convincing enough story, so pick your cohort that's rising. There's definitely, and that might even steer your business, right? If you've got 20 different metrics that you're looking at. So again, I think that's a secret that a lot of people don't recognize, is that a lot of times you're in control of your own destiny. I will come in and I'll question them and challenge them and whatnot, but at a certain point, if you have a few metrics that are going well, use those, focus on those, see what you can push and get result from. And if you can prove that you can push something and get a result, then that's intriguing enough to make an investment. So this is what Justice Potter said about obscenity back in the 60s. He said, I don't really I'm not going to try to define hardcore porno, but I'll know it when I see it. And that's sort of how I feel about some of these growth stage metrics. I'm not really sure, I don't have an exact bar as to what it's going to look like, and oh, you have to have this, this, and this, and if you filter through this, then you're going to get money. It's more one of those things that when you see it, you'll know what it is. And that's frustrating, I know, but set through 75 pitches a quarter, and you'll start to realize. So I'll show you a couple things that have been put out in the public, and then some that haven't. So this is LinkedIn. This is a presentation that Greylock showed. And what's nice about this is a great example of a pitch that was a concept pitch, because these numbers weren't great on a relative basis at the time. But what they did do was they set their own hurdle, and then they exceeded it. So they went around to the venture community, and they said, look, this is what we're expecting, and then they beat what they were expecting. That's pretty genius when you think about it. You meet somebody now, because you're not going to take a first meeting and then raise money. You're going to take a meeting, and then it's going to be a month later, 2 months later, 3 months later, 4 months, and they're going to drag it out for as long as possible. Nobody wants to give you money on the spot unless it's super competitive. So that's a great example of somebody who set a bar and exceeded the bar. Still a concept pitch, but with some early data. And then they exceeded that data, so that was a big plus. Even if they hadn't have exceeded it, there was a lot of wiggle room in here to play with that. So now I'm going to show you something not a lot of people have seen before. Again, I don't have a lot of great things to talk about, but I can show you a little bit of history. And this is the presentation that YouTube delivered to us back in '06. And this is one when we were in the room, it was kind of one of those, oh yeah, we're doing that. And I can show you a little bit about why. And it was really these right here. I mean, talk about a grabber, 700%. I didn't even know exactly what these were. I just saw the 700%, and I was like, wow, 900%. That sounds great. It's almost 1,000. Why not round it up? 15 million a day, 1,400. It just keeps getting better. You see, it's all small little things. Not a lot of distraction there. But you can see, in today's world, these aren't really that amazing. I mean, there's definitely a lot of growth, but if you sort of look at where YouTube is today, and then you look at other companies that have followed the Instagrams of the world, there's a lot more. So they didn't have to play with their chartware too much, but they definitely worked with what they had. You can see them. Again, this is always a nice one. Again, you get to pick who you're putting against. I think there were some people who were maybe doing a little bit better at the time, but they chose their own hurdles. I'll just flip through these guys here. It's fascinating for me just from a history. I like to dig out my old emails from there and feel smart about myself. I'm a little sad at some of the videos I was sharing back then. So we had 3 million visitors in December. You know, these guys had, at the time, for the amount of money they were looking for, the revenue number was okay, but it was obviously a lot in the projections. The problem with making big projections out, as you can see, looking for triple double, is that you only have a small amount of time, because if you don't hit those. So that's the push and pull with setting your own metrics, is you can set your own metrics, but if I drag it out long enough and you miss them, then you're toast. So it's nice to project something big and growth, but if you don't hit it, then it's a problem. So sometimes people want to come in, and I see, you know, again, remember, most of your people you're pitching to have seen a lot of deals, unless you're doing angels and it's, you know, the rich uncle or somebody who hasn't seen a lot of deals and they're just excited to be part of Silicon Valley and some startup that their nephew or neighbor's kid has. But when you're talking to people who are seeing these deals all the time, then when you come in with a percentage growth number that's bigger than anybody else in history, it's a little bit of a red flag. So be a little careful there. Maybe you have it though, in which case, let's talk. And so here's some of the stuff that Paul talked about, looking at those consumer pain points. I can tell you that realistically, the biggest pain point that YouTube solved at the time was that extra 5 seconds of buffer time. And that might sound crazy, but coming out of the telecom world and you're talking about 5 nines latency and the difference between a split second on somebody answering the phone call and the voice delay. When you're sitting at work and you're on break and your video's buffering because you want to watch that funny video that your buddy sent you, that extra 5 seconds is a really big deal. And that was actually the pain point. It might seem silly, but I think we all can relate to that. Just flip through. You can see where these guys went. We came in here on the and led the B round, but you can see where they were right here. And look at this time scale's off for some reason, but you can look from May of '05 to October of '05. this was basically the seed round, if you will. So a lot of seed rounds are sort of angel rounds, or even at this point, if you've made a lot of money already from PayPal or wherever else, you can bootstrap it yourself. And then you look, and here, even today, similar numbers that Paul was talking about $3.5 million Series A round. And then given the growth, and again, back then, the CapEx requirements were a lot higher. It's funny to look at the architecture back then and what it required. You're building your own data center, right? You don't have Amazon to outsource to. So you had to, now you can stretch your dollars a little bit longer. This is just a little bit of ancient history, but again, they put the ones with only 400% in the back. So that's really all I have for you guys. I don't know if you want to have any questions for Paul and I, or if there's anything else we can tell you about.
Maybe it's a silly question, but do you ever ding anybody when you graded and they so radically exceeded their projections that their initial projection just should have been higher?
No.
The question is, have you ever dinged anybody for sandbagging, right? For setting an expectation that was low, and then I always use the example of of your home life with your significant other. Have you ever shown up 15 minutes earlier than you said, or have you ever gotten them a bigger diamond than you said you were going to do? And have they ever been disappointed? No. There's pretty much no disappointment when somebody upsides any expectation, even in the public markets. That's it. Anything else? Yes?
I just wanted to ask you, when companies invest in Series A, are there ever cases where they're pre-revenue and they have a prototype and they might have users, but they haven't really figured out monetization? Do Series A's happen in that case, or is that usually only happening in the seed early stage, so to speak?
Yeah, from my perspective, the A and B, and that's sort of our specialty, I think, is not the early stage, because I don't have the expertise that Paul does, but where we can come in and other firms specialize in helping that monetization piece. So you've already got something to work with. If you don't have, once you get into that B round, if you don't have financials or data though, that's when it gets a little choppy. But in that A round, data alone is fine, and that's users or metrics or whatever analysis you want to do. But I don't even think that, even in the B round, you don't necessarily have to have financials. A lot of people will pick one or the other they're going to focus on. In fact, in this area, in the type of companies that we're dealing with, for the most part, monetization doesn't even come around until maybe the C round or so. But again, only if your numbers are strong. If your numbers are strong enough and there's proof that you're going to be able to monetize it at some point. I think after this in 2014, it's pretty clear that if you have millions of users and you're growing X%, we can make money off of it. I think that's it.
Well, yeah, everything Mike said, I would add that it depends on business type too. If you're a media company, zero revenue at A round is expected, right? Show engagement, show people love your content. I talked about enterprise. I know a lot of people doing A investments saying 5 or 6 meaty clients. Doesn't matter if they're paying yet. Doesn't matter. As long as you have 5 or 6 meaty clients saying they're doing something really valuable for me, they're solving a lot of pain, and even when they start charging me, even if they haven't yet, it's going to be a lot less than what it would cost me to solve it by myself. So it depends on sector. I picked 2 examples where it probably has the lowest hurdle, but yeah.
So you mentioned in your earlier presentation about how virality was such an important piece for you to look at when you're looking at, are you starting to hit that growth curve with the virality sticking in? And that makes sense for a lot of the consumer stuff, but maybe more the enterprise or the B2B space. What's your analog there?
Right, so the question is, what's the analog for virality in the enterprise space? I'd say it's an exact analog, actually. Let me think of model. Like, there are a lot of enterprise companies whose goal is to get a beachhead into one customer who's going to use, for personal use, is going to keep their files at Dropbox, but they're a Boeing employee. And then they find out how great it is, and it goes out to their group at Boeing. And then other groups find out how great their collaboration is because they all have access to this shared space that they can get to from anywhere, from any device. And all of a sudden it's at 8 groups at Boeing. And then before you know it, it's all of Boeing. And Boeing has 8% turnover on people every year. And those people go to other companies. And so, I would argue the virality works maybe with some different mechanics. And you don't see as explosive a virality necessarily, but it's all still there on enterprise to me.
Yeah, I mean, if you're talking about enterprise software, for sure. If you're talking more about an enterprise where you're building out an enterprise class Salesforce, et cetera, that's a different story. That's about having reference customers or trial customers and commitments and whatnot to buy. So that's a little bit of a different animal. But if you're talking Yammer or Box or something that's that enterprise class software, then there's definitely been an expectation of similar morality to the consumer side. But again, when you're talking more of a Box or sort of an enterprise CTO level sale, that's a bit of a different animal. That's about launching with maybe 20 beta customers or something.
So is there a different side to virality in terms of like Flappy Bird, for example? I know that's in the game space, and maybe that's really something unique to being a game. But I mean, being overly viral and ending up crashing and burning like in 30 days.
Well, it didn't burn. I took it down.
You took it down. I mean,
yeah.
it's hard to know what the next step of it is really going to be, or what its VCs or angel investors are really going to expect from it.
Hey, I'll extend that model actually. So the question was, is there a possibility of over-virality? Can you have a viral implosion? And I would argue that you could have a distribution implosion regardless, right? You can win and have the best product. You can win and have a good enough product and the best distribution. You can have the best distribution and a crappy product, and you're probably going to get the same thing, right? You have a great distribution team that brings customers on like crazy, and they go away, and you burned it, right? Because most of the time you get one shot for somebody to take a look. And after that, you try to get them back in 6 months, and they're going to be like, oh, I remember that crap. I'm not going back to try it again. It tasted bad the first time. And so I would say that's true with all. So you can have great products and not great distribution. You can probably do okay. You can have good both, that's fine. You can have great distribution and a good enough product, that's fine. But if the product, if it doesn't solve a problem at the end of the day, then the best distribution in the world won't save it. And it'll just burn money faster.
Define a needy enough enterprise client versus
Say that again?
Paul mentioned, for Series A or B2B company, it's good to have 5 median enterprise clients. 5 median or...
Oh, okay, so the question is for an enterprise class Series A, what are median clients when you say you need 5 median clients? From my perspective, that would be, guys who are literally publicly traded or sort of branded companies that are in that $5 to $10 billion type of range, whether it's a Salesforce.com type or somebody who has a CTO, a CIO that you're selling to and hundreds of employees. I would think that would be sort of not necessarily selling to IBM or Goldman Sachs or Wells, but somebody in that sort of mid-cap tier would be my.
Aside from cash, what do you bring to these companies that you're investing in at a seed round or an A round or a later round?
I'll let Paul talk from the seed round perspective. From our perspective on the B and C round, it is about that monetization strategy. So for us specifically, and we try to only bite off companies that we can add value to. I mean, you see a lot of companies, so a lot of the philosophy for a VC, as Paul said, there's only a few people who only have 3 partners. And so, is it something that, even though, just because I pass on something doesn't mean that it's not a good idea or that it's not going to make money. It's, do I want to live and breathe that idea for the next 2, 3, 4, 5 years of my life? If it goes wrong, do I want to stay up all night thinking about it? So I see a lot of great ideas, but I'm just not personally going to give it my all. It's the same as you as entrepreneurs. Are you going to spend all your time? If you don't love your idea, you're not gonna do it properly. And that's the same thing for a good VC. So it's somebody that you're going to partner with. I've been amazed at the lack of value that a VC can bring, but I've also been amazed at the value that they can bring in terms of helping to hire, in terms of literally customer introductions, in terms of partnership introductions and whatnot. We've been able to bring people into the office and close multi-million-dollar deals within an hour. Just because it's a vetted, it's the same as you when you go out and network. An introduction from somebody is a lot easier to get a job or to get whatever else it is than sort of a cold call coming in.
So look, early stage is a competitive environment, right? There's something like 400 funds that are $50 million or less that are out there competing for early stage deals. And it's a marketplace, like I was saying earlier. There is supply and demand. All the funds have their own philosophies. They all have their own approaches that they're going for. And so my particular fund, Subtraction Capital, we believe in making pretty meaty sized seed stage bets for a fund of our size and being really involved. So I spent my afternoon at intern match with Nathan, actually, and with Nathan's UX designer. And we were sitting down and we were going through the backlog, and we were brainstorming new ideas for the next optimization round. And so we prefer to be sleeves rolled up and really in there working. And I spend a half a day of my week, 4 days a week, and so does my partner, right, at a different company. One company in the morning, one in the afternoon is my typical. But there's a limit on how many companies we can invest in with that philosophy. And so you can look at investment strategies at different places. All VCs will say our goal is to be as helpful as possible, and it is. But their ability to do that and the character and the nature of how they're helpful will be different depending on their investment philosophy. If you're trying to put, I'm reluctant to throw even ballpark numbers around because I don't want to pick on anybody. I think everybody's got their philosophies and what they like and why, and they'll be successful, and that's great. But if you're trying to put $20,000 into 100 companies a year with 2 partners at a fund, you're not going to be spending much time with them, right? You're casting a broad net. You're trying to make sure that if there is a new Facebook, it's somewhere in that 100. It's a different philosophy than ours. And so you'll see variety. I think it's almost impossible for particularly a new entrepreneur that hasn't been at the rodeo before to know every firm out there and what their flavors are and what the backgrounds of the people are. And it's one where I say, like, make your advisors do some work, right? Your advisors should know the funds. They should have been to the rodeo before. Bug them about who you should talk to and why. And, like, get detailed, right? Why do I want this person helping as opposed to that person helping? One upside of 400 firms being out there in early stage is we're being forced to brand ourselves as well. So we have to claim a vertical or a focus or an area and say we own that. And we have to try to defend our space, right? And we have to prove to the market that we own that better than anybody else. And anybody who's kicking ass in that space is going to be coming to us because we own it. People are claiming geographies, people are claiming verticals, and some people are building networks, and there's value to all of them. But yeah, it's different for every firm. Is that fair, Nick?
What's the vertical that Subtraction Capital is claiming?
Subtraction Capital is after disruptive software, so not a pure business vertical, if you will, but chasing the disruption front. And if you don't mind me marketing a little bit, right?
Distributed.
Disruptive. Disruptive. So a place where software is coming in and doing something typically that people used to do at a fraction of the cost and at huge margins compared to before. It's an inherently different business model getting dropped on top of an old business model. That is Jason and I's experience in career. They say invest in what you know, right? We were never vertical loyal. I've worked in financial services, healthcare, consumer media, enterprise software. Jason has a similar, varied background, just chasing. So yeah, we invest in what we know. One, because we understand the mechanics of the business model and the values, and also because we're going to work for them. I'm literally going to roll my sleeves up and work on backlogs and things. And I got to work on what I know, or I'm not going to add value.
So maybe you could talk a little bit about, let's say you're an entrepreneur, you've built a product that you're happy with, and you want to make that initial leap to speaking with, to get some seed funding. What kind of things should you think about before you make that initial leap? Tangibly, how do you start deciding who to make your first phone calls to? Can you talk about that process a little bit?
Sorry, can you repeat the question?
Yeah, I'm trying to, paraphrasing, I hope, is sort of how do you get started? You've got an idea for a direction you want to go to, and you're thinking you want to get some seed funding to accelerate traction on the idea, so where to get started? Is that?
And you've already built something and you're ready to sort of reach out and supercharge the seed funding. And what first steps should you be thinking about? Who do you start to call to build a network?
So you may or may not have advisors already in the area. And I look to advisors first because they leverage everything else you're going to do. If you want to go out and get funding, you need to figure out who's going to fund you. So who funds your space? Who's trying to brand and own that vertical that you're in or have that focus? And you got to start working on your pitch deck. And you got to practice pitching too. It's real. There's some of the things I didn't talk about up here are the things you're going to have to do the most. I'm going to let Mike fill in too.
Yeah, I mean, I think it starts with your, in school it's your business plan, and here it's your pitch deck, and if you don't have an advisor, I mean, I think Paul's right. You generally start with your advisor because your seed round is going to be. It's nice to have some anchor, somebody somewhere that you've been working with that who likes your product and whatnot. So not many people have been building it completely in a vacuum. They've been building with a partner, and there's people that they've touched around them that are interested. So that's the very first step is coming up with an advisory board or a couple of guys that are there that like the product and can sort of help you reverberate out and reach where you want to reach. And it's all well and good to sort of target depending on where you are. If you're at the point where you don't even have any seed funding, then it's going to be hard to be super targeted and put all your eggs in one basket. You're going to need to get that deck and sort of go a little bit wider with it. But a lot of this the truth is a lot of it's qualified introductions. Into people, and that's going to start with your advisors and go through because it is tough. I mean, like I said, we probably see about 75, or I personally see about 75 companies a quarter, and it's a lot. And some of them I meet just to kind of stay in the flow of what's out there, and some of them I meet because they look interesting and fascinating, and some of them I didn't think I would like, and I ended up liking them. So, but just building, it's like any other thing. You just got to start to hit it hard.
Can I tell one story related to this too? So I used to take our summer interns at one of the companies that I was at out to the venture fund, who was our largest investor in the summer. And they would invariably ask that same question, how should we get introduced to your firm, sort of. It was a little more focused than what you're asking, I remember, so we used to sit down, and I was the entrepreneur, and the venture firm was the venture capitalist, right? And we would each answer the question. And the venture capitalists always went through figuring out who invests in what and why and how you can get that qualified introduction, which is the best way if you can do it, don't get me wrong. And then it would be my turn to answer the question, and I would say, if I can get anybody at this firm that I heard of once to take my call, I'll pitch them. So if you can get the qualified investment, great, but there's value to practicing, there's value to getting help from people that won't end up investing.
There's probably 3 to 5 meetups in the neighborhood that have pitching every month. Start there, go to those things, network.
And suggesting meetups as places to pitch as well.
Is it easier to raise capital when you are a profitable startup?
Yes. That's the law of the land. Is that people will give you. The question is it easier to raise capital when you're profitable? And the answer is yes. It's like all things in life, you get what you don't need. The more money you have, the lower the bank fees are. And it's just a sad truth of the world. But.
So that wouldn't be a red flag.
Look, some of the best companies are companies that don't even need money. Some of those are the best deals that people line up and chase. But to Dan's question earlier, at that very early stage, it's like being an indie band. You got to get in your van and you got to eat ramen and roll around and look for it. Unless you have that great backer, unless you've done it before, or you have somebody that's evangelical on your side.
Last question.
Why are true businesses wrong with the VC world?
Why are what?
True businesses. Talking about branded e-commerce, real companies.
So the question is, why are true businesses dogs? That's a big question for the last question.
Because you both are tech VCs.
Mm-hmm. Yes.
You guys don't deal with regular branded companies.
That's correct.
But there is a slice of the pie of VC that does go towards consumer.
Yes.
But I think most of the literature out there is really about the tech VCs, the true tech VCs, which you two are.
Yes.
How about the consumer guys?
Yeah, I mean, I think from our perspective, first of all, it's time and place. You know, it's 2014 and I'm in San Francisco and I've been here for 15 years, and so that's what's here and that's what my area of expertise is, and that's what we do. I think the bigger question is something that the bigger answer is something that Paul said earlier about capital expenditure and input and leverage. And so what's happened in the tech world that's really exciting and it attracts capital is the ability to leverage capital that you don't necessarily get in branded or consumer products or any other industry for that matter, because we've gone down the Moore's Law curve. We have things like AWS. You can start a startup now. You can start YouTube now for 1/10 the price. You can start eBay or any of those other companies for 1/10 the price that you could 5 years ago, 1/10 the price from that. So when you're dealing with like a packaged consumer good or another product, it's a lot more difficult. That said, I would challenge you because what I've seen this year, if you look at actual venture funding from 2013, what I will call products have actually, post-Apple, have actually started to take off. Nest, $3.2 billion. You've got Dropcam, which is doing quite well. So we've actually seen some of that tech money move into those products, but they are different products. I went to buy a sump pump 5 years ago and I was appalled. It was $400 and it was either on or off. I had a basement that was flooding, and you put this hunk of metal down there and it turns off or on. It was the same price as my iPhone. I got GPS, I've got 5 bands of wireless, I've got Wi-Fi, a compass, and all this other stuff. And you're telling me that sump pump for $400 has an on-off switch? No way. But you look at what Nest has done with thermostats, same thing. Why? It's appalling how bad those other thermostats were. It's appalling how bad the smoke detector was. Those are products.
But Nest is different.
Exactly.
But Nest, the promise of other things that you can interact with Nest.
But Nest
It's not
is
an actual thermometer. The thermometer is the excuse to get it in the house. That's not a true consumer play. That's a tech play.
Well, Whirlpool, we could talk about Whirlpool. What happened to Whirlpool when LG came into the market with, you look at what happened to the U.S. white goods market that literally had no innovation for 10 years, and you look at what came out of Korea. I mean, an LG washer dryer won Best of CES 5 or 6 years ago. Now, the difference is, it goes back to capital intensity. LG and Samsung are literally multi-billion-dollar companies that can invest and can innovate. But the innovation that came to there was silicon. It was about sensors, and it was about display, and it was about connectivity. So we could argue all day about whether or not those innovations came from this area, because other people made more money selling silicon and connectivity and display into LG white goods than LG did from their sale of white goods. So it's a big question. We can take that offline.
Crickets in it. Just teasing. Yeah. I'm just teasing. I guess all I would say is that disruption is like a front, right? It's like a wildfire that rips through and burns out fuel. And once it burns through a forest, it doesn't go back there right away. It may go back there, but it takes a little time usually before the lowest hanging fruit is in the forest that has already burned once. It's not to say there is no e-commerce play out there that's worthy, and there are. I'd say they're more niche. And it's not to say there won't be more in the future, there will be. And particularly as new technologies, it's like, first there's the internet front, then there's the broadband front, then there's a mobile front, and there'll be the Google Glass front, right? And all these technologies will come in and create new low-hanging fruit for disruption. But relative to a lot of things, like e-commerce is a tough space that a lot of people have already scorched the earth on. Not sure if I'm crazy about looking there as a broad category. Anyway. Hey, thanks everybody for coming out tonight. Yeah, sure. So next month, it's March 18th here. Satya Patel will be here, former head of product at Twitter, talking about growth.
All right, thank you for coming out. Real quick, if anyone is hiring, or if anyone is looking for a new gig, you can come up here and you have 15 seconds to say something about yourself, and then if anyone wants to talk from there, you can sort of find each other. So come up here and take the mic from me.